Well, joining us now for some investment insight is Kimon Boyiatjis, CIO at Trident Capital. Kimon, thanks so much for joining us this afternoon. Let's get straight into it and let's take a look at the sense you're making of the kind of activity we're seeing on the markets. Today, the JSE, for example, back in negative territory, and it seems that the confidence or the improved sentiment that increased liquidity in the system over in Europe managed to inject over the week has faded fast.
Hi there, Alishia. I think that we had to have a pullback. We've had a really wonderful run, roughly, but it depends which index you're looking at, but roughly 8% in 2 months. It was the end of the month yesterday, and I think a pullback was warranted. Market may be a little bit overbought in the short term. I'm not too concerned about the liquidity fading. We tend to have some kind of movements at the end and beginning of each month, cash flow readjustments. So if in the short term, I'm not too concerned about it at all.
Not concerned about liquidity failing. Where are you sitting with regards to your view on what liquidity is doing to asset prices right now?
Well, it's what we've been feeling for a long time, that the central banks globally have been using the same medicine to try and get us out of trouble, to what got us into trouble in the first place. And liquidity can be creating new bubbles. And it inevitably does find its way and create bubbles in some asset class or another over time. But in the short term, that additional liquidity to the system is certainly underpinning most of the financial asset classes, and primarily equity markets, I think, are still going to be the beneficiaries of it in the short term.
How do you weigh that up, Kimon, against the new troubles that it may be spurring up at the same time? Because just this week, all attention has been on that oil price rising steadily and fast beyond that 126 level, and it's had implications in terms of views on inflation and in turn views on economic growth.
Certainly, I think what tends to happen is you get these spikes, and we're still actually very bullish on oil. We think that on average the oil price can rise 10% globally. And it certainly does have a negative impact on growth. It has a negative impact on inflation going forward. But one has to monitor it. We've seen that spike up. If it stabilizes and stays around current levels, what we then have to look at is how the currencies of each region perform, because it's effectively, in South Africa's example, the rand price of oil, which is going to affect our inflation down the way. And over the past couple of years, while we did see an increase in the oil price and the gasoline prices, a lot of it was tempered by a strong move in the rand. So we benefited from an inflation perspective. But I suspect with the rand being in a trading range, higher oil prices are certainly going to be negative for us going forward. But again, I think that those are longer term implications and not going to have an immediate impact over the short term.
What's your outlook on that rand moving forward?
We still think it's going to be range bound, possibly down to about 725 and back up to 8. So I think from the midpoint, you're going to have a 5% fluctuation either side. I think we will have moments of volatility, and it tends to happen when there's an event globally, and that's something beyond our control. But on balance right now, I do suspect that the rand will be pretty much range bound.
What is within your control is how you position yourself within this context. So run us through your investment strategy and what you're holding front of mind at this stage.
Okay, as you're well aware, we increased our equity holdings from 40 to 50% roundabout in November, which for us is a high weighting. We still love inflation-linked bonds. I think the areas of concern are certainly vanilla bonds, and that when the yields get a little bit too low, we think one should offload. And much more importantly, while one needs those in a portfolio for the diversification purposes, we prefer to be at the shorter end of the yield curve. In other words, bonds up to 10 years in duration, and obviously good quality bonds at that. I'd be avoiding the US Treasuries like the plague, and if I had to hold them, I'd ensure that I had some kind of insurance. I think they're very overpriced, and it could trigger a big move up in yields over time, particularly as we mentioned earlier with the oil price, if that's got some inflationary effects.
So let's hone in on that 50% allocation that you've got dedicated towards equities specifically, because we've seen interesting play in the markets this week. Investors jumping on the bandwagon of financial banks in particular, and that despite the downgrades that come through from ratings agencies on South Africa's top 5 banks, and a move out of the resources segment of the market.
I'm still one who favours resources. I do believe that the diversified miners, and particular Anglo, I like, but that's for a number of reasons. One of the reasons being potential corporate action. I'm sure it could be a target within, for example, Xstrata's vision. So I'd be looking at that. Sasol is something we really like, being bullish on the oil price. And if the rand is pretty stable, again, that share should outperform. When it comes to the banks, we had dipped our toe into the water. I think the top 4 banks have performed pretty well over the last 2 months. And from a technical perspective, we also believe that most of the institutional investors have been underweight banks. So, I do suspect that once we've seen bad news and the market rises despite the bad news, one then can believe that a large part of the negative news had already been discounted in the share prices. So I do think financials will continue to do well over the next couple of weeks, and particularly March is a big derivative closeout, which certainly does add volatility to the equity market. And if one just takes a step back, you probably find that most portfolios in South Africa are quite relatively underweight equities to what they have been in the recent past. And what you might find is that a lot of these institutional investors have to come into the market to top up. And as the market goes higher, they are pressed to do so.
Well, Kimon, let's leave it there. Thanks so much for your time this afternoon. Kimon Boyiatjis, CIO at Trident Capital.